What if some of the biggest obstacles to building wealth aren't low income, high inflation, or even the stock market, but the financial advice you've believed for years? Many people think saving small amounts doesn't matter, that investing is too risky, or that retirement planning can wait until they're older. These ideas sound reasonable at first, but over time, they can quietly cost thousands or even hundreds of thousands of dollars in missed opportunities. In today's video, we're breaking down 6 of the most common money myths and comparing them with what financial experts actually recommend. By the end, you'll have a clearer picture of how small decisions today can shape your financial future. Managing money isn't just about earning more, it's also about avoiding costly misconceptions. Financial myths often spread because they sound simple or are repeated so often that people accept them as fact. But personal finance is rarely one size fits all.
Whether you're just starting your career, building your savings, or planning for retirement, understanding the facts behind these common beliefs can help you make more informed financial decisions. Let's begin with one of the most common myths of all. Myth number 1. Small savings don't matter. Many people tell themselves there's no point in saving unless they can put away a large amount every month. In reality, financial experts say consistency matters far more than perfection. Even modest contributions can grow over time, especially when you make saving a regular habit. Starting early gives your money more time to benefit from long-term growth. If you're unable to save the commonly recommended amount right away, don't let that stop you. Saving something is generally better than saving nothing at all. Experts suggest balancing your budget so you can cover essential expenses like housing, utilities, groceries, healthcare, and debt payments while still setting aside money for emergencies and long-term goals. The key takeaway is simple. Build the habit first. Then increase your savings whenever your financial situation improves. Myth number 2. Investing for retirement is too risky. Another common belief is that retirement savings should stay in a bank account because it feels safer. While savings accounts help protect your money from market fluctuations, they usually provide relatively modest returns over the long run. That creates another challenge: inflation. As prices rise over time, the purchasing power of cash gradually declines. In other words, the same amount of money may buy less in the future than it does today. That's why many long-term retirement strategies include diversified investments rather than relying entirely on cash. A diversified portfolio built around your goals, investment timeline, and comfort with risk can help balance potential growth with risk management. For people who prefer a simpler approach, employer-sponsored retirement plans often offer diversified investment options, while target date funds and professionally managed accounts can provide additional guidance. Myth number 3. Retirement can wait. Because I'm young. When retirement is decades away, it's easy to believe there's plenty of time. But one of the greatest advantages younger investors have isn't necessarily a higher salary, it's time. Over long periods, investment earnings can generate additional earnings through a process known as compounding. As returns are reinvested, future growth has the potential to build on previous gains. The earlier you begin, the more years your investments have to potentially grow.
If your employer offers a 401k plan with matching contributions, contributing enough to receive the full match can be especially valuable because it's part of your overall compensation package. And if a workplace retirement plan isn't available, opening an individual retirement account, or IRA, may be another way to begin saving for retirement. Why planning matters. So far, we've seen that small savings can add up. Long-term investing plays an important role in retirement planning, and starting early can make a meaningful difference. But another question remains. How much money will you actually need for retirement? That's where many people make another costly assumption, and we'll tackle that next, along with 3 more financial myths involving retirement planning, debt, and credit cards. Myth number 4. There's no way to know how much you'll need for retirement. One of the biggest reasons people delay retirement planning is because they assume it's impossible to estimate how much they'll need. While no one can predict the future with complete certainty, that doesn't mean planning is impossible. Financial professionals often use savings benchmarks as general guideposts to help people measure their progress over time. For example, Fidelity suggests aiming to save about 15% of your pre-tax income each year, including any employer contributions to your retirement plan. The company also provides savings milestones designed to help people stay on track. Its general guideline is to have saved approximately 1 times your annual income by age 30, 3 times by age 40, 7 times by age 55, and 10 times by age 67.
These aren't guarantees, and they won't fit everyone's situation. Your retirement needs will depend on factors such as your lifestyle, expected expenses, healthcare costs, where you plan to live, and when you intend to retire. The important message isn't hitting every milestone perfectly. It's continuing to save consistently, increasing contributions whenever possible, and giving your investments time to grow. Even if you've fallen behind, making gradual improvements today can still strengthen your financial future. Myth number 5. Every type of debt is bad. Debt often gets a bad reputation, and in some cases, for good reason. High-interest credit card balances and expensive personal loans can become difficult to manage if payments continue to grow faster than your income. But treating every form of debt as harmful oversimplifies how personal finance works. Some borrowing can help people achieve long-term financial goals. A mortgage, for example, can make homeownership possible, while student loans may help finance education that leads to higher earning potential. These types of loans often carry lower interest rates than credit cards or unsecured personal loans, and in certain situations, the interest may provide tax benefits under applicable tax laws. Of course, that doesn't mean any loan is automatically a good idea. Responsible borrowing means comparing lenders, understanding the total cost of the loan, borrowing only what you truly need, and making every payment on time. Debt itself isn't necessarily the problem. The real challenge comes when borrowing becomes unaffordable or is used without a clear repayment plan. Myth number 6. You should avoid credit cards. Completely. Credit cards are often viewed as financial traps, but the reality depends less on the card itself and more on how it's used. When cardholders pay their balance in full every month, they generally avoid interest charges while still benefiting from the convenience that credit cards provide. Many cards also offer rewards programs, including cashback, travel points, or other redemption options that can add value to everyday spending. Another important advantage is building a positive credit history. Using credit responsibly and paying bills on time can help strengthen your credit score over time. A stronger credit profile may make it easier to qualify for future loans, rent an apartment, or receive more competitive borrowing rates when financing a vehicle or purchasing a home. However, these benefits disappear quickly if balances are carried month after month and high interest charges begin to accumulate. The goal isn't to spend more because you have a credit card. The goal is to use credit strategically while staying within your budget. Bringing the myths together. Looking across these 6 myths, a clear pattern begins to emerge. Many financial mistakes don't happen because people lack intelligence or discipline. They happen because common misconceptions influence everyday decisions. Believing that small savings don't matter can delay investing for years. Waiting too long to start retirement planning reduces the time available for compounding. Avoiding investments entirely may leave savings struggling to keep pace with inflation. And misunderstanding debt or credit cards can lead people to miss opportunities or take on unnecessary financial risks. The encouraging news is that better financial outcomes don't always require dramatic changes. Often they begin with simple habits, saving consistently, investing with a long-term perspective, borrowing responsibly, and making informed decisions instead of relying on common myths. Those habits, repeated over many years, can have a much greater impact than trying to find the perfect investment or the next financial shortcut. The biggest financial advantage isn't luck, it's good habits. After looking at these 6 common money myths, one lesson stands out above all the rest. Building wealth isn't usually about making one perfect financial decision. Instead, it's the result of making good decisions consistently over time. Many people spend years searching for the next hot stock, the perfect investment strategy, or a shortcut to financial success. But in reality, lasting financial progress often comes from habits that may seem ordinary. Saving part of every paycheck. Investing for the long term instead of reacting to short-term market movements. Taking advantage of employer retirement benefits when they're available. Using debt carefully and only when it supports meaningful financial goals. And managing credit responsibly by paying balances on time and avoiding unnecessary interest charges. These actions may not feel exciting, but over the course of decades, they can make a significant difference. Another important point is that personal finance isn't a competition. Everyone starts from a different place. Income levels vary. Financial responsibilities differ. Unexpected expenses happen. Career paths change. That's why comparing your financial journey with someone else's rarely helps. What matters most is whether you're making better decisions today than you were yesterday. You also don't have to be perfect. You may not be able to save 15% of your income immediately. You may have started investing later than you hoped. You may still be paying off debt. That doesn't mean you've missed your opportunity. Every positive financial habit you build today has the potential to improve your future. Small improvements, repeated consistently, often lead to meaningful long-term results. And perhaps the biggest mistake of all is believing it's too late to begin. Whether you're in your 20s, 40s, or approaching retirement, taking action today is generally more valuable than waiting for the perfect time that may never come. Let's quickly recap the 6 myths we covered today. First, don't underestimate the power of saving. Even small, consistent contributions can make a difference over time. Second, while investing involves risk, relying only on cash savings can reduce your purchasing power over the long run because of inflation. Third, starting retirement planning early gives your investments more time to potentially benefit from compounding. Fourth, retirement isn't impossible to plan for. General savings guidelines and milestones can help you measure your progress and make adjustments along the way. Fifth, not all debt is harmful. Used responsibly, certain types of borrowing can help you achieve important life goals. And finally, credit cards aren't inherently bad. When managed responsibly and paid in full each month, they can help build credit and provide useful rewards without incurring interest. The common thread through all 6 myths is simple. Knowledge alone isn't enough. Putting that knowledge into action is what can make the biggest difference to your long-term financial well-being. If you found this breakdown helpful, consider sharing it with someone who's working on improving their finances. A single conversation can help someone avoid costly financial mistakes. And if you enjoy clear, fact-based coverage of U.S. personal finance, investing, business, and the economy, be sure to subscribe to Capital Compass Daily. We publish straightforward analysis designed to help you better understand the financial stories that shape your money and your future. Thanks for watching. We'll continue following the latest developments in personal finance, investing, and the U.S. economy. See you in the next video.